All right, let's start. Good morning, good afternoon, good evening, everyone. All friends of Luohan Webinar, Happy New Year of the Horse. I think this is the first webinar for this new year. It's especially nice for me given that my last name is Ma. Hope everyone 马到成功. And yeah, and I'm also very glad that this webinar we started like 5 years ago now enter into the sixth year. I counted it's our 86th webinar by far. It's also a very good number. And where it's our great honor to have Professor Winston Dove from Wharton. He's a tenured professor at Wharton, and his research covers, I think, very wide topics in finance, especially bring the technique in industry organization into finance to study many important questions. What I find personally very impressive, number one, has two PhD, one in statistics from Yale and another from MIT Sloan. Two, and his work covers both theoretical and empirical aspect, and both do very well and achieve both breadth and depth, as we can see from today's work. I want to emphasize a little bit that today's work is one of the serious work of Winston Dole and his co-authors on how AI trading affect finance and affect human algorithm computation, collaboration, and we may have a future another webinar on some other paper. Their first paper, I think, got very influential, very successful. This, I think, is the second paper. And without further ado, the floor is yours, Winston. And yeah, I really looking forward to what you will give us. Thanks.
Thank you so much, Eugene, for the overgenerous introduction. Hello, everyone. So my name is Winston Doe. I'm a faculty at the Wharton. So it's my great pleasure to introduce and present to you my very new paper with my co-author Itai Goldstein, also my colleague at Wharton, and Yan Ji, who is a professor at the HQST. So in today's paper, we're going to talk about, um, so if this kind of major strategic players in the asset market, in the trading market, start to adopt um, advanced AI technologies, so what would be the financial market implications? Particularly in this paper, we focus on the implications on financial market instability. Um, so actually, we are in this era of AI. For the past few years, especially those quantitatively equipped large investors and traders, they have started really use advanced technology involving AI. So because of this, the regulators all over the world start to face like new challenges and feel nervous. Here, I give you one example. So Gary Gensler, the former SEC chairman in the United States, in his multiple interviews and speeches, kind of urged the regulators to tame AI risks to financial stability. Specifically, he emphasized that. Here I have two quotes. He talked a lot about this actually. So one is he emphasized financial market instability or even a financial crisis caused by AI is nearly unavoidable without regulation. And then he also he went more specifically by saying that even if humans are not talking with each other, humans are not communicating or knowing who are the players in the financial market, the machines will start to have a sense of cooperation. So this type of cooperation is one of the focus of today's paper, like our previous paper. But in the previous paper, we study the financial consequences or risk of such AI cooperation, specifically for market liquidity. But in this paper, we study the similar mechanism, but actually, as you can see, this is The mechanism will be a little bit different, but still it's machine cooperation. But how this will affect the financial market stability or instability? Um, so why dealing with AI is a challenge for regulators, right? So first, I want to emphasize because fundamentally, the AI or artificial intelligence actually is fundamentally different from human intelligence. This has been emphasized actually by many AI top experts, including Geoffrey Hinton, the godfather of AI. So he emphasized that the kind of intelligence we're developing, I right? So AI is very different from ours, very different from how our brain works. So briefly speaking, right, for AI, the fundamental mechanism is just pattern recognition. No matter how fancy the algorithm is, but the foundation for AI intelligence is purely based on pattern recognition. But for human, our way of thinking or our intelligence is more like logical thinking or intuitions. And legally in practice, actually, they are also very different. The AI collusion and the human collusion are very different. This has been shown in several previous papers. One is Cavano et al.'s AER paper 2020, and in uh, my paper was Yitai and Yan. Our previous paper, we also try to emphasize this point. So why they're different? Especially legally in practice, because AI collusion falls outside the scope of existing market manipulation and antitrust enforcement frameworks. The current frameworks, legal frameworks, really emphasize communication as a solid evidence. Why that's the case? Because in many case studies and experimental studies on humans' behavior, for people conclude that, or people figure out that for humans to coordinate or collude, in this kind of complicated uh, real world, communication is vital. It's crucial for humans to sustain such collusion. For example, when Inju and I, if we want to collude on the trading or financial market, first we need to know oh, I'm maybe trading with Yingju, right? And then beyond that, so I can target at Yingju to send out signals or some direct communication. People find that's necessary. But for AI, they don't need any of those. So AI, when they are trading, they don't need to know they're trading against AI human or who they're, they're really trading against. As long as you launch them in the market and the AIs, they will interact with each other and they're smart enough to reach this type of collusion. So they can collude without any form of communication, even without intent. So even if I showed you in this paper too, even you look at each single line of the code of the AI algorithm, there's no single line of code uh, give any like a guidance for the machine to collude with each other. Each line of code is very innocent. It just try to maximize its own trading profitability. Okay. So that's why it's super challenging for the regulators. And because of this, actually, for the Congress in the U.S. For the past few years, they kept urging for this kind of antitrust law and market manipulation law reform to kind of deal with this new type of phenomena driven by AI trading or AI decision making in the markets. In this paper, as we show in the title, we'll be focusing on AI planning. So what is the AI planning? So this is like a little bit technical term. So typically for this, self-learning and autonomous AI agent, fundamentally there are two types of algorithms. So one type of algorithm is called reactive learning. So this is something actually being studied a lot for the past few years in the literature, this reactive learning, including our previous paper. So reactive learning is a reinforcement learning that chooses each action based only on the rewards direct from the action. So most of them are model free, which is actually a very appealing feature. But in practice, people try to deviate from this because even it's very robust, but not that efficient. And most importantly, for reactive learning, it does not recognize how choices will affect the future payoff related relevant states. By payoff relevant state, it means some state variable directly enter the payoff function, right? For example, the price level, right, is important state variable that directly enter the payoff for any investors. So for reactive learning, they are not sophisticated enough to try to internalize how their current action will directly shape the future multiple periods, right, in the future about this payoff relevant states. Well, by contrast, AI planning try to you know really focuses on anticipating how current choice will affect the future payoff relevant states. And how to do this? Basically, you can think the AI planning relative to reactive learning is to incorporate either forward simulation because they have typically they will at the same time have a model about the environment, and based on this model they can do this forward simulation to anticipate, okay, if I do A, and this would be the possible multiple steps in the near future. And if I do B, those are you have a, you can the machine will simulate a tons of other possible states as a consequence of their action B. So the machines can also do that based on some model-based backward induction, just like more like humans, more like economists, how we solve dynamic problems. The backward induction is based on Bellman equation, right? So that's the key difference. And actually, AI planning is not something very new. It has been the core technology behind agentic AI systems, including AlphaGo, AlphaZero, and self-driving cars and robots. So in this paper, we'll compare both algorithms. Basically, we'll show you actually more advanced algorithms like AI planning. They can create potentially huge financial market instability because those machines can coordinate together to create a bubble and leads to crash. Right? By contrast, this kind of more naive reactive learning, they cannot create such financial instability risk. So the question in this
Can I ask a
paper,
question?
yes.
Okay, so just to clarify, in these
Mhm.
two category, which category the Q learning, that's I think very popular
Yeah.
learning algorithm we study
Mhm.
is in these two.
Oh, both use Q-learning. Both use
I see.
Q-learning,
Okay.
but the detail, there's subtle difference. So for the reactive learning, it's a Q-learning. You're absolutely right. But this Q-learning, they are model free and they are very reactive. They don't do this kind of planning. And don't do this backward induction. Later you will see that when I show you the formula, it will be very clear. And for this AI planning, so for this, they're not just thinking about, okay, what I should do now, just for this one period. They're thinking about, okay, my target is maybe 10 periods or 5 periods, right? That's my target.
I see.
So based on this, based on my understanding of the environment, how should I do this more intertemporally more strategically? So how to do this in a more strategic way intertemporally? Okay, that's the
Got
difference.
it. Thank you.
Yeah,
Winston, yeah,
Avery.
yeah. So this really active learning, the more like a backward looking, and this AI planning, the more like a forward looking.
Yes.
Yeah. So I have two probably clarification questions. Number one, maybe we communicated before in conferences about calorie thing, maybe related to the
Mhm.
first paper, also related here. So
Mhm.
so in game theory, so we know that in the kind of infinite horizon models, we can have implicit coloring. Maybe that's not in, supported by experiments or something kind of that
Mhm.
can also be an equilibrium, right? So that's
Mhm.
maybe one interpretation might be suppose it's just humans. It's difficult to support this kind of implicit collusion in the traditional game theory. So, but you can interpret current financial market as humans using those machines as their implementation. So they
Mhm.
kind of this is more like implementation of the traditional implicit collusion concept, equilibrium concept. This is more like an implementation device. I think this is kind of interpretation wise. I think this is regarding the collusion thing. So there's the first comment. It's maybe a comment. The second one, you mentioned that human and machine very different in terms of this kind of collusion behavior. And so we want to regulate them. The regulation framework will be very, very different. But we also want to understand maybe the consequence might also be very different. You have a different collusion behavior, and you have consequences for financial stability. So now since you have different players, maybe the definition of stability or welfare consequences can be different. So we cannot also use the old measure to regulate this market. So maybe this kind of fragility might be good even for humans. You suppose you have human and machine. The machine is for if you only machine, maybe stability, instability, fragility is bad. But now you have a machine and human, maybe this instability is good for the human. Might we should not regulate them. That's
Mhm.
yeah. There's two questions. The first one is interpretation. I think that maybe kind of
Mhm.
interpret this as an implementation of the old concept. And number two is about how you think about this regulation purpose. So the behavior is different, and then so what should we think about the regulation? Yeah.
Mhm. Yes, thank you, Lian. So for the first point, yes. So basically, when we work on theory for this repeated game, that's the typical fundamental framework for us to study collusion. So in that framework, yes, even for collusive equilibrium, typically they have like many of them. So we don't really know as economists, it's really hard for us to say, which specific equilibrium actually will be in. So typically for the past decades, for the theorists, we pick someone, we select some equilibrium. Even among the collusive ones, we say, oh, this looks more closer to people's behavior. For example, this price trigger strategy and the sort with certain punishment and grim trigger strategy with certain punishment. So Lian is definitely right. So it's like, typically in theory, we do like by brute force, we subjectively pick some equilibrium to focus on in our theoretical studies. So here you can imagine we don't do such thing. In this kind of in my papers with E-types, we don't do this. Why? Because we instead of like assume like impose any equilibrium we're going to focus on because we kind of impose the algorithm. We kind of say, okay, what if the AIs adopting this type of algorithms? And then we use a simulation and some heuristic proofs to show actually they will converge to a certain type of equilibrium. So Lian is right. So basically here is you can view this at a very high level in the theoretical perspective. Our paper can be viewed as a equilibrium selection problem. So it's like we say, okay, if the algorithms are specified in this way, they will robustly to pick this type of equilibrium. And many of other type of equilibriums actually, in theory, they're feasible, but they are not very relevant in this setting. Yes. So second point, um, so one thing we want to emphasize is the mechanism is very different. AI versus human, how they coordinate, manipulate the market to manipulate the market is very different, but the consequence is actually quite similar. The consequences, for example, in the previous paper is more like the market liquidity will go down and price informatives will go down. So in this case, actually, if you replace these machines by humans and somehow legally or illegally they form this kind of collusion, create bubble and crash to benefit from this, this consequence will be the same. So that's the challenge actually those regulators are facing. So basically the consequences are very similar, at least in the implications we're discussing, the market liquidity, market efficiency, and the market instability, but the mechanisms are fundamentally different from humans. So that's why it's challenging. Okay, right? Thank you. So let me keep moving. So the key question in this paper we're going to study is, will AI-powered trading amplify financial market instability? And specifically, first, we try to address the question: can oligopolistic AI speculators coordinate through intertemporal planning by first trading aggressively to generate negative bubbles and then unwinding their positions gradually to extract profits? You can see this is like typical, bubble creating and exiting for profits, for right, manipulation, intertemporal manipulation. Can AIs coordinate to do this? And then we ask the question, can purely reactive learning algorithm can also achieve similar coordination and thereby amplify market instability or fragility? The answer is no. So later I'll show you and discuss why. And in the end, we'll discuss how can regulation prevent AI planning technologies from amplifying financial market fragility or potentially triggering the next financial crisis. So actually to create such, to coordinate together to create such bubble and crash, it's not trivial. Um, why it's not trivial? Because unlike traditional collusion in product markets, coordinating to generate profitable bubbles faces two fundamental challenges. So one is time inconsistency. So this kind of like really rooted in this nature, intertemporal nature of this trading, right? It's very different from typical product market collusion. Why? Because so here, in order to really grab profits from this type of manipulation, first create bubble, and then exit also in a coordinated way, is when you create bubble, actually for the first part, the manipulators actually bear a lot of loss, right? Because to creating bubble, that means you keep buying up or pushing down the price too much, right? By doing this, those manipulators need to bear the loss. So they bear the loss in the hope that later, right, when the bubble is large enough, they can, when they, seduce or lure, like, some momentum traders to enter this game, start to buy or sell following their steps, they can gradually sell their position or unwinding their position, right? So to make profits. So, so you can see this is really like two steps at least. First, create bubble, and then you kind of attract many momentum investors enter the market trying to buy or sell if it's negative bubble, and then they find okay, now it's time for them to gradually unwind their position to make profits. But for this, they are facing this time inconsistency. The idea is, for example, if Yingju and I, we both say, let's quit bubble. Why we're doing this? Because we have this plan. Let's quit push up the price a lot. Then Yingju and I, we can, gradually sell our position. No one will run before each other, right? Rush out. Let's just gradually do this. Then we can maximize our profits. But the time inconsistent means once we create ex ante, it sounds all good. It sounds like perfect plan. But ex post, once Inju and I, we create a big bubble, especially a very big bubble, then exposed. For both of us, we have incentive just run, right? Because that will back then that will be the uh, optimal decision, right? So you have this kind of time inconsistency. Second is even trickier. It's called endogenous punishment breakdown. So what does this mean? It's also rooted in the intertemporal nature. The idea is if Yingju and I, we both create a bubble, right? So creating bubble is costly. So both of us want to be the free rider. So if I was thinking, okay, why don't I just let injury to pay the cost, push out the bubble, and then I just when the bubble is created, I started to trade in the opposite way gradually. So, but for this type of behavior, typically, right, when injury figure out this, injury say, okay, in the future, or in the second step, especially when we are selling the position, injury will not coordinate with me anymore. Injury will say, I will sell in a crazy way or very aggressive way. I will not coordinate with you anymore because you are free riding me in the first step. So, but this kind of threat is not credible. Why? Because in this case, this type of threat is based on we can create a big bubble. But if I'm free riding or even I deviate in a way, it's more profit way, I trade against injury. So injury keep buying, try to push up the price, right? Uh, Create a big like a positive mispricing, for example. And I know this. I think, okay, now is a good time. It's for me to make money. I just trade the opposite way. I just start to short selling. So my deviation behavior actually make this kind of big bubble not materialized, right? Based on this, there's no bubble actually, uh, you know, uh, after a while. So no way Inju can punish me to say, okay, I will exit the bubble, exit his position very aggressively because I just don't care. There's not much he can punish me. There's no bubble. I already made a lot of money by short selling from very beginning, right? Trading against the Inju. So you can see this is the two uh, challenges actually, even for this coordinated bubble creating and the coordinated exiting based on there's a condition, there's a big bubble creating the first step. And even for this, due to these challenges, there are no theoretical benchmark available in our literature. So in this paper, we're going to first establish this theoretical benchmark. So in this kind of environment, what kind of mechanisms can sustain this kind of coordination to create bubble and exit in the coordinated way. So to be more specific, we figure out one compounded price trigger mechanism which can overcome this. So what do we mean by compounded price trigger? That means in the first step or layer one, in theory, so uh, the 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 idea is if someone deviate from the first step of like bubble creating step, right? So we need to all push up the price. No one can free ride. No one can take advantage of others, right, by short selling. If someone is doing this, no matter what, even there's no bubble created, people will trade very aggressively uh, on, in the second step, right? And this type of crazy trading is not incentive compatible, right? That's the new thing. So it's not incentive compatible. It's like crazy behavior. So, but how to sustain such a crazy behavior as a punishment for free riding or deviation, short selling deviation in the first step? Because if when we move to the second step, if you don't have this kind of crazy behavior to punish the first step, bubble creation step, deviation, then there will be another incentive compatible punishment. That one will be okay. Then everyone in the future will the major players, they're not going to coordinate anymore, right? So they're not be coordinated to create bubbles and profit from that. They will reverse to this competitive trading. You can see there are two layers, right? Compounded. So basically, the first punishment is not incentive compatible, it's a crazy punishment. But to sustain this crazy punishment in the first step, you need the second step. It's more like incentive compatible one. It's like people will reverse back to competitive trading in the future. So this type of mechanism, we have to say, is not we are now the first paper to in general to introduce this. There was a recent JPE paper 2020, not that recent, but 2020 is a theory paper. They kind of propose a similar mechanism for product market competition. And then the question, the second contribution is, okay, so now we set up like a very simple Q learnings, uh, with AI planning feature in it. The question is, can this AI planning, can this Q learning algorithms with AI planning autonomously learn and achieve this very sophisticated, as you can see, this compounded price trigger strategies, and first create bubbles, and then leads to crash-like unwinding, and thereby amplifying the financial market instability. And the answer is yes. And we also ask the question, can naive reactive learning algorithms do the same thing? The answer is no. The naive reactive learnings, they cannot learn, autonomously learn such compounded price trigger strategies and create bubbles. So in this sense, actually more naive algorithms actually is a better news for financial market stability. Okay, so this is the overview of this paper. Now let me go into the details. First, I need to introduce the setting and the Q-learning setup. So the setting we're considering has this type of time structure. Actually, it's a very natural time structure for financial market, for trading. So basically, imagine that we have infinite episodes indexed by t. T is from 1 to 3 to infinity. So here I showed you, right, each block is one episode. But within each episode, we have subperiods indexed by h, right? So here actually we have three subperiods, h of 4, h equals 0, 1, 2, 3 in each within each episode. And this subperiods can start not from very beginning of the episode, because when h equals 0, basically it's try to capture some information events like earnings announcements and new stock issuance events and FOMC announcements and other macro announcements, right? It's like some within, for example, if it's earnings announcements, you can imagine it's like within each episode is more like a quarter, and those sub periods more like days or even hours. And the beginning of the sub period, our discussion is the day or the time when the firm make earnings announcement. Okay, so this is like a time frame we're discussing. And then based on this time frame, let's introduce this Q learnings within this time framework. So the Q learning setting we're considering is actually in AI literature. It's called multi-agent system. So it's not just one AI is trading in this environment. The multiple of them, okay? And at the same time, each one is like an oligopolistic player. So they are big enough, so their trading behavior in our financial setting, you can imagine their trading behaviors have non-trivial price impact. Okay, so they're not tiny. And for each one of them, they try to solve this value function maximization problem. So it can be categorized by this Bellman equation, right? For us, the economists is we are all very familiar with this formulation. So basically here, this VIH is agent I's optimal value function in subperiod H given the state SIH. And this optimal value function will be achieved by choosing the optimal trading behavior XIH in that subperiod. And to maximize the combination of expected current trading profits will be captured by UIH and also the continuation value, right? The next subperiods expected optimal value function. And the second row is the one we go cross. We go cross episode. So the only difference is here we apply a different time discount factor row, right? So that's the only difference. When little h equals to capital H, the last subperiod in the episode, because this one will be go cross episode. Okay, so you can see that's almost like standard Bellman equation setup. The one point I want to mention, so this kind of payoff function, right, UIH, of course, it will depends on, the action chosen by the player I itself. But at the same time, because here is a multi-agent system, it's more like a game, right? Game theoretical framework. So this UIH for each I also depends on the behavior or the actions of other agents in this environment. Okay, so that's something you need to keep in mind. So it's like more like a game theoretical framework. And the Q-learning is basically trying to solve this dynamic optimization problem. The AI try to do this. So, but how the Q-learning do this? They don't impose the assumptions about, oh, they pretend they know this true distribution and know how to compute this expectation. Or they kind of like pretend they know what equilibrium they're going to end up. Like this typically what the economist uh, have been doing, right? For all the time, basically. We kind of assume some distribution. We assume, okay, we kind of impose an equilibrium, and then we solve this. For AI, it's different. They don't make they don't make any of those assumptions. What they do is they first take one step back. In order to solve this optimal value function, the AI try to solve this value function we call Q function for any state and action pair, right? It's complete. It's like exhaustively to solve. Give me one state. Give me one action. This action doesn't have to be the optimal action. What will be the value function? And once the AI can solve out this Q function, the optimal value function and the optimal action will be trivial to figure out because the optimal value function by definition would just be the maximum Q value function, right? Over all possible actions for a given state. So they have this tight relationship, right? And then what the machine does is to replace this optimal value function in this Euler in this Bellman equations by the by this with this kind of like relationship. So you have a recursive relationship of Q functions. So these two equations are actually the just basic the central equations recursive relationship the AI or the Q-learning will be using to estimate the Q value functions. How they do this? Instead of like assume there's like, they know the distribution of this dynamics, they will repeatedly try. And then they accumulate their experience for many rounds. So they basically use law of large numbers to get a very good approximation for this expectation sign here. So that's the key idea of Q-learning and reinforcement learning. Let me be more specific. Now it's time let's to understand what's the difference between Q-learning with AI planning and the Q-learning just for reactive learning. So Q-learning for the AI planning, you can think they try to solve this coupled Q matrices or Q functions for each subperiod from subperiod 1, 2 to H, right? They solve them at the same time. And then they fully recognize this kind of backward induction relationship between those Q matrices across different subperiods. How they do this? It's more like this is kind of more like through this multi-step planning with backward induction. So they recognize, okay, when we estimate this Q1, Q matrix for subperiod 1, it depends on the Q matrix in the subperiod 2. And how to figure out the Q matrix for subperiod 2? It depends on the Q matrix in the subperiod 3. And how to solve this and so on depends on Q matrix in subperiod 4. And in the end, the last subperiod's Q matrix will depends on the first subperiod, the Q matrix of the first subperiod in the next episode. So we'll loop back. But here the machine may apply a different discount factor, time discount factor, right? So that's the whole system. So the machine will just like iterate this system of, recursive relationships, and then they will actually, in theory, we can show somehow this Q hat will converge to some Q matrix. And for each step here, this is how they update the queue. But when they update the queue, they update at one state and action pair, right? For state, it's out of control of the machine. It's the environment will decide what state they're facing in at time t and for in episode t and for one subperiod. But the action is something chosen by the machine. So this is the key point. The machine will choose the optimal action for each subperiod following two procedures in the mixed way or in the randomized way. So typically with a big probability, 1 minus epsilon t, you can imagine this epsilon t is a small number. The machine will just follow what they learned from before. They just say, okay, now the situation we're facing, this is the same state as IHT. And for this state, what will be the optimal action based on our previous experience? We will play that. So this, we call this exploitation procedure. But occasionally, the AI will deviate from this originally learned optimal behavior they want to explore because they were afraid this previously optimal ones maybe is a local optimal. So they may want to do some exploration. So that's why the second step is called exploration. So this one they will just choose some random action in this action space with small probability. So that's basically our algorithm. It's a mix of exploitation and the exploration. And the exploration rate, epsilon t, will decay over time because when the machine learn over longer time, they will trust more and more on their previous knowledge, the knowledge from previous behaviors, right? So they will trust more, rely more on this previously learned optimal decision. So now this is the AI planning. So this is reactive learning. Reactive learning is there's no intertemporal planning. That means when the machine trying to learn the subperiod one's behavior or the Q matrix, it only depends on the subperiod one's um, outcome in the past. So you can see each row, there's now coupling. So basically, they try to say, okay, because I'm learning subperiod one's action, I only focus subperiod one's Q matrix in before. So they always have this iteration for each one. The subperiod one only depends on subperiod one's. Subperiod two's Q matrix only depends on subperiod two's, and so on, right? So that's the key difference here. They don't recognize, oh, actually, I'm trying to do a multi-period within one episode. This multi-period optimization problem. And then this exploitation and exploration is similar. Okay, so these are the two mechanisms. And before we go to the, say there how they behave, let me first formally set up the experiment environment and the theoretical benchmark. So basically, we have many episodes, and within each episode, we have 4 subperiods, and the discount rate is equal to 1 over 1 plus interest rate. Interest rate is a constant in our environment, and at the same time, we have one long-term risky asset which will pay dividends. The dividend follow this AR1 process, and with shocks WT and the V new T, and this WT and the new T actually one they are independent, but they will be realized. WT will be realized in the subperiod 2, and VT will be realized in the subperiod 3, and the dividend will be paid in the subperiod 4. In the totally, we have 4 subperiods. And given all this, we can compute this fundamental value of this asset. And we have 4 investors. Well, the first type of investors, there are many of them. They're low frequency and risk neutral investors. Because they're low frequency, they can only trade at the very beginning of the episode and the very end of the episode. So they cannot trade in between. Because there are many of them, they're risk neutral. Uh, their trading will guarantee at these 2 points the market price exactly equal to the fundamental values. Okay, so just keep in mind at the very beginning and the very end of each episode, there's no mispricing because the existence of such investors. And we have I number of oligopolistic informed speculators. You can imagine them as large quantitative hedge funds like Two Sigmas, some big funds in Point72 or Citadel. Um, uh, so basically, those guys they will say this omega t at the very beginning. So like before any other investors. So it's like a private information like in Kyle framework. And they will decide their trading strategy. We kind of like restrict to linear trading strategy at that period based on this private information they receive. So this trading strategy is for at subperiod 1 and 2. So this kind of 2 subperiods in the middle. And then I said they're like a continuum of positive feedback investors. So they're like momentum traders. They don't look at the fundamentals. Their trading behavior, their demand purely depends on the price movements. If the price increases at the beginning of the episode, they will buy more in the later episodes. If this price decreases a lot from at the beginning of the episode, they will sell a lot in the following subperiods, right? So that's momentum traders. And of course, we have arbitrageurs, but we assume those arbitrageurs, they are smart, but they are constrained. So they can recognize this, mispricing between the market price and the fundamental price, fundamental value of the asset, but they can just do this to a certain level. This level will capture by this parameter Kasai. They will trade against this mispricing. And then the prices will be pinned down in the equilibrium by market clearing conditions. Okay, so that's the environment. So these figures show, in this time framework, the information structure in the red. So at which time, each subperiod within each episode, what information the investor can see. And under the black ones, try to illustrate this, the market price and the fundamental value dynamics. So at the long story short, so just at the very beginning, h equals 0, h equals 3, in the end, the market price equals to a fundamental value. There's no mispricing. So the manipulation of the mispricing can only happen for this kind of like, intermediate subperiods, h equals 1, h equals 2. So these 2 periods are the AIs will start to truly manipulate the market. And then we have 3 types of like benchmarks. I'll go through quickly. So we have non-collusive Nash equilibrium, which is the competitive equilibrium. The other one is perfect cartel benchmark, which is monopoly equilibrium, just one big trader. So try to manipulate and the market, take advantage of this momentum traders and make profits. And what's interesting in between is collusive equilibrium with planning. So this is the one will sustained by this compounded price trigger strategies. Okay, so we have some measures about market collusion and the market stability. And here is the first theoretical results. So basically, here's a case with mu is low. So mu is crucial parameter.
Hello.
Yep.
Hi, Winston.
Hey, how are you? Oh,
Hello.
hey, yeah, I can hear you.
Yeah, I'm a long term from Luohan
Yeah,
Academy.
how are you?
So, may I ask a very naive question?
Mhm.
Um, so, so Previously, in theoretical models, we basically model investors as rational, some of them rational, they have planning
Yes.
ability, stuff like that. And we're
Yes.
talking about human beings. I'm trying to understand how AI agents are different from human beings this time. Can you tell me that?
Yes, that's a great question. So that's the heart
You
of
talk
this
about
research.
some of the
Mhm.
fundamental obstacles, but those are things seems to be also would show up in human environments. Am I correct?
So that's tricky. Is in theory can show up in human because uh, from the rationality. So maybe in the theoretical models, typically we assume humans are rational expectations, right? But we all know that's a simplification.
Right, exactly.
They're not that rational. That's one argument, right? Especially for this kind of super sophisticated, like what I showed you.
Well, but economists have been doing this for a long time,
Yes,
assuming that humans are rational
yes,
and they have multi-periods. They're doing expectations, they're doing rational
exactly.
decision prices,
Yes,
stuff like that. And
yes.
are you saying that? be- you, so how can we switch this to AI agents? How is that different?
Yes, the difference is like rational expectation is a strong assumption, like what I emphasize in the Bellman equation part, because there are two things. One thing is rational expectations, you usually assume they know the true distribution, right? They
Right.
know true distribution. We know that's very strong assumption. Second, rational expectation is even stronger. That means before everything, this rational expectation agent, they understand what equilibrium we're going to end up. That's the stronger assumption of rational expectation. But in AI, they don't have any of those. Okay, so that's the fundamental difference. Another practical difference is even for the rational expectation agents, in practice, let's say they humans are really rational expectation agents. We know the distribution, we understand what equilibrium will end up. But to achieve this coordination, for example, Long and you and me, we need to say, okay, we need to have some communication between humans, some sort of communication, right? Typically, we'll discuss, we'll talk, but for AI, for the experiment we're going to show, the AI, they don't even know who they're trading against. There's no communication at all. So that's why in the SEC and in the DOJ, when they try to charge the manipulation, they need to usually have a solid communication evidence. You guys have phone calls, you guys have some meetings, right? So they have to use those as a solid evidence for their charge or enforcement. But for AI collusion, there's no such thing. There's no evidence of no way you can find any evidence of communication. So that's the key difference. I hope I explained myself uh, clearly.
I'm trying to catch up to this. So
Mhm.
I'm I guess uh, anyway, let me think a little bit about it. Why don't you
Sure.
go on and finish, and then I will come back to
Okay.
you
Yeah, thank
a
you.
bit later. Yeah.
Yeah, thank you. So here I showed you this theoretical benchmark. Let's just focus on the first graph, the trading flow. So here they glue all together because the mu is low. That means there are not much of momentum traders in this environment. That means there's not much room for manipulation anyways. So that's why the monopoly case, the competitive case, and collusive case, the three lines, they all almost stay together because there's no room for manipulation. There in this setting, there only room for manipulation if there are enough like momentum traders. That means mu is high enough. So by contrast, let's switch to another environment with a lot of like momentum traders with high mu. In this case, you can see, right, the trading behavior between the monopoly case, competitive case, which is in red, and the collusive case is very different. So in the competitive case, actually they trade smoothly because they don't do manipulation. For the monopoly case, this guy will say, oh, there are tons of momentum traders. They will trade very aggressively in the first sub period and push up this overpricing. And then they start to sell. they sell all this to this momentum trader who start to buy and to make money, and then wait for the convergence of the price. And and the closive case will be in between. And here, let's look at the panel D. That's the price dynamic. So in this case, the green one is a fundamental value dynamic. You can see it's very smooth over time. And the red one is competitive trading. It's also smooth. But if you go to the conclusive and the monopolistic one, we see this clear big bubble creation and a crash like pattern, right? We have this market instability. Okay, this is in theory. So now let's go to the experiments. So the experiment is just like, in the general framework, we just uh, give very specific specification, very reasonable ones. For example, now the trading profits by definition is just like the trading quantity times price change. The trading quantity times the price change. That's the trading profit. And for state, what are state variables? So here we assume they're tracing the previous market price and the previous information they receive and the current information, right? So basically that's the information set the AI has. It's not everything, it's just a small set. But we show even with this small set of like information they're using, it's enough for them to figure out this super sophisticated trading behavior and make tons of profit, but at the same time at the cost of others and creating this large market instability. And here is the settings of our experiment, just some like calibrated numbers. So let's skip this. Let's go to the simulation result. So we can see here, this is the case when mu is high in the environment. We have a lot of like, momentum traders. And we can see here the coupled Q-learning. That means Q-learning with um, AI planning. They do behave like, they create a bubble, they trade aggressively at the very beginning, and then they sell in a coordinated way to this kind of momentum traders and grab a lot of profits. And to compare with benchmark, the red line again is the theoretical benchmark for competitive trading. You can see this trading behavior. Obviously, we have this kind of first aggressive and also aggressively unwinding. And then, but for reactive learning, that's this black dotted line. They trade smoothly. They cannot create a bubble. To see this more clearly, let's look at this panel B. That's the asset pricing dynamics. So again, this blue curve is a smooth fundamental value curve, and this red curve is this perfect competitive case, and the blue one is the AI. If they trade together, they create bubble, create bigger bubble, and then crash, right? So they create this kind of financial instability. And by doing this, they make a lot of profits. If you look at panel C, to create a bubble, they first lose a lot of money, but they can gain a lot of money in the second step. Once they create a bubble, once they kind of attract a lot of like momentum traders to enter, they sell their position at high price level to these momentum traders. They make a lot of money waiting for the price to converge. So they make this is the dynamic. They're smart enough to do this. And given limited time, I may not have time to show you this very direct evidence. Actually, the machines really figure out this compounded price trigger strategy. First, they punish by crazily aggressive trading behavior. How to sustain that? Because later they have another, incentive compatible one. It's just revert back to compatible trading behavior for several episodes in the future. So we can show this through this kind of impulse response figures. But given the limited time, let me skip this. And now let me conclude. I'm running out of time. So in this paper, we show this coordinated AI planning can emerge without communication or even intent. Because we know the code we are setting up, right? So if you look at each line of the code, each line of the code is 100% innocent. But somehow those machines, they can work together to figure out this, actually, I would say super complicated intertemporal coordination scheme, right? To deal with this time inconsistency, to deal with this endogenous weak punishment, and to create a bubble, and leads to crash. And one policy thing is like, why we study this reactive learning. One interesting thing is like maybe the SEC in US, right, all the trading platforms can follow, what has been doing on Amazon. So on the platforms for product markets, they can launch some AI to counteract those kind of sophisticated AIs. So in our setting, we show actually if the SEC, for example, the agencies, they can launch a reactive AI, very naive AI, also trading. Actually, they can I don't show because I don't have time to show in this slides. We have this in the paper. They can break down this kind of a coordination. They can drag this whole uh, trading behavior of other sophisticated AIs back to competitive behavior. So and stabilize the market. So and at the same time, those kind of reactive AIs can make some money, and those money can be paid back to taxpayers. So thank you so much. Sorry for running out of time over time. So that's the paper. Yeah.
No, it's
So,
great.
May
Now we are
I
open
come back?
for more questions. Yeah.
yeah.
No, please.
Okay, so how likely you think this will happen?
Yeah.
And yeah,
It's a great question. So we were like presenting Ita and I, we went to FINRA and ICC, MF to talk with regulators, and in their eyes, this very likely this already happening. But it's hard to know. That's why they kind of like really have high demand or call for research. The reason is in this trading environment, even for the regulators like FINRA, they don't really know, for different investors, especially hedge funds, how they are making their trading decisions. Whether it is like what we show in our paper is really like autonomously uh, by this kind of like reinforcement learning, or it's a mix human plus some reinforcement learning, or it's still traditional algorithm trading, which means that even it's like a um, automated trading behavior, but the trading rules are like 100% human made. So it's not clear. So that's why they call for studies. So they want to say, what if this kind of reinforcement learning is the decision maker behind? So they are trading, but they're also learning from the real trading. So what would be the behavior, unique behavior? So their idea is they want to, from the research, to identify certain unique patterns. And then they can look at this in the real time. They can look at this trading patterns
well,
and the
so
price
can
dynamics and
you?
identify. Yes. Mhm.
So in this paper, have you identified any clear pattern
Yes.
so they can
So
use to identify?
exactly. So yeah, that's impulse response. So basically, we say, right, this intertemporal within certain small episode, we say if a certain thing happens, what would be the reaction of other AIs? So whether this some AI will start to aggressively treat in the opposite way, otherwise doesn't make it much sense. That kind of like crazy punishment behavior. The reason is in practice, a lot of this kind of here's a price trigger strategy. So basically the traders they don't really say each other's behavior, right? So they can never say this. For
All right.
example, Long Yu and me, we are two
So let
hedge
me,
funds.
given
Yeah,
the interest of time, I
yeah.
want. So, uh, I guess my problem is that can you have some clearly identifiable pattern investigators can pay attention to? And if you see some pattern, how can you distinguish from human behavior? It's not clear to me. I mean, it seems to me that you are somehow
Mhm.
proving theoretically it's possible, but empirically, it seems very hard to use it. Are we at this stage, or I don't understand this?
So empirically, so here in this paper, as I So basically, there's one behavior. It's a trigger behavior, right? The trigger is like a very aggressively. Some you see this kind of big investors. If you see the pattern, they kind of like crazily trading in the some way. That way even doesn't make much sense. They lose money, right? From regulator, if I'm regulator, I can say their trading behaviors, all everyone's trading behavior. Even I don't know how they make a decision, I say trading behavior. If they do some, there are some like um, price movements, right? So for example, they're buying, they're buying their previous minute or previous hour, they're buying, and there are some others doing the opposite. So the price doesn't go as majority of like big investors like Two Sigmas and they wish to go, and then suddenly they go to the opposite direction very aggressively, right? So over aggressively. So if you see that pattern, it's a price trigger pattern. So that's a very unique pattern here, right? So because it doesn't make
And
sense.
humans don't do that.
Uh,
Humans don't do that.
it's really hard for a human to really realize. But for example, for human, if you and me, right,
Okay.
we communicate, we really have agreement, and we code this into our algorithm, then this algorithm trading can achieve similar things. But again, so if we do this, we need the communication. Then we are at a huge risk. The SEC, they may figure out how we communicate. They may figure out some evidence, then we're in trouble. Yeah. But for AI, everything is self-learned. Yeah. Yeah. So people believe it's
Okay.
not.
I'll
Yeah.
leave.
Yeah. Thank you.
Hmm.
Yeah. Do you have any other questions? Right. Yeah, actually, get back to Long's question. I think Lian and Winston, they have another paper directly working on this, and maybe they can talk more about that in the future.
Oh,
I also noticed
I
had
see.
an excellent reply in the chat. Yeah.
So long.
So,
So yes.
yes,
Okay.
please.
To follow up that, so here the machines can achieve this. Actually, there are two important assumptions. First, AI, actually they're smart, right? So second, here there are two important assumptions. One is the AI traders, they are big, so they can create market impact. So that means if they want to push up the price or push down the price, they are capable. When they work, few of them work together. Second, they need some private information at the very beginning before others to do. So they have something to manipulate on. They already know, okay, the fundamental value will go a certain direction. So they start to manipulate in that direction. So both a little bit of private information advantage plus their market power, these two together, give them room to coordinate and manipulate the market. So in the paper, Yinchi mentioned with Lia and Itai, a new paper, we do the experiment. Let's say we remove these two advantages, information advantage and market power. Whether AI can do better than human. The human, even some behavior, irrational human, we show actually is not the case. So because AI has this disadvantage in the sense AI can only learn from the market behavior. If the market behavior is not that smart, even you have the most advanced AI, the AI cannot be very smart because the data just reflects a lot of stupid behaviors. So the AI cannot be trained based on the data as a very smart trader. So that's the one of the major point of that paper. Yeah. Thank you.
Right, that's an excellent discussion. So, yeah, great. So that ends our webinar today. Thanks everyone for coming, and please looking forward to the future of Luohan webinar on digital economy. Thank you.